Welcome to Tennant's monthly investment insights for June 2022. Over the last 90 days, the stock market has dropped by 8.5%. This negative move can largely be attributed to the inflationary fears both locally and globally. When inflation goes up, it means that money has lost some of its value. Rising inflation has been driven by a combination of events such as COVID-19 lockdowns and fiscal stimulus. That's money printing, especially in the US and China, and in the war in Ukraine. Central banks, such as the SARB and Fed, manage inflation with interest rates. Central banks now need to increase interest rates to slow inflation down. US inflation is currently at the highest it's been in 4 decades. This means that role players such as the central bank, government, companies, and asset managers do not have personal experience on how to successfully manage the current situation. Thus far, it seems that central banks globally have not responded as effectively as they could have to the rising inflation, which has resulted in rapidly rising interest rates, and that has made the cost of debt unsustainable. Thankfully, the situation in South Africa is slightly different, in that the South African Monetary Policy Committee has been consistent and prudent in their response to rising inflation. South African interest rates are actually expected to stabilize towards the end of 2022. So what does this mean for you and your investments? Interest rates directly relate to the cost of debt. If the interest rate goes down, debt is cheaper and you have more disposable income. That's more money to save, more money to spend. If the interest rate goes up, it costs more to service your debt, which results in less disposable income. Effectively, this means that you now have less money to spend at the Pick and Pay. For the Pick and Pay, this means less income, which might ultimately affect their share price. While this all sounds very unsettling, it is important for us to understand that this type of fluctuation is not unusual, and feeling anxious about it forms part of what is known as the cycle of investor emotions. If we do not understand this cycle and how to respond correctly to what we're experiencing, we might make rash decisions, resulting in us buying and selling at all the wrong times, locking in losses, and never seeing a return on our investments. Investors all start with optimism. We commonly expect things to go our way and expect a return for the risk of investing. This is followed by euphoria when we believe everything we touch turns to gold. That is until the market stops meeting our lofty expectations and begins to turn. At first, we anxiously watch the market for any signs of change. Anxiety turns to denial and then quickly to fear as the value of our investments decline. And so the cycle continues. During the last phase, many panic and withdraw from the market altogether, locking in their losses. Ironically, at these times, an investor will commonly fail to recognize they are actually at the point of maximum financial opportunity. It's almost like the shares are on sale. Admittedly, I'm not able to predict what the future holds or when the market will peak or bottom out. What I do know is that emotions turn rational investors into irrational investors. It is important to remember that markets move and investments will always go in and out of favor. The temptation to respond emotionally can be resisted by developing and committing to a well-defined long-term investment plan. Stay the course, remain invested. Remember, it is time in the market, not timing the market, that will make the difference.